First, I'd like to thank everybody for taking the time to join us this morning, and a special thanks to our special guest panelist. We have with us this morning Tom Lepke, who is a former DCAA auditor, and Tom has also been both a controller and a CFO at government contracting firms since being a DCAA auditor, so has a lot of experience in accounting systems and compliance with government requirements. So welcome, Tom, and thank you for joining us today.
Well, thank you, Mike. It's nice to be here. And good morning or afternoon, whatever your situation may be, to everybody out here.
Great. So today we're going to talk a little bit about the meeting government requirements, especially the FAR and DCAA requirements. Here's a quick outline of what we're going to talk about. And I think it's important to note right up front that a QuickBooks system can be completely adequate for a small business being a government contractor, and there are ways to make that adequate, and there's a lot of businesses out there using it. But if the company continues to grow, at some point it may become too cumbersome to continue to use QuickBooks, in which case you might need help, whether that help would be enlisting a consultant to help you, or it might be a different software to help you in meeting the government's compliance that would make life easier to do your accounting. So what we're going to talk about today is kind of QuickBooks, what things you have to do to make a QuickBooks system compliant, and then ways you might recognize if you're outgrowing that system. So that's kind of where we're headed today. The first thing in talking about any government compliance system is talking about the requirements. What do we need to meet? And with the DCAA, they use what's called a standard form. And Tom, I know this is very familiar to you. I thought maybe I'd let you just kind of go over this real quick and tell people from the DCAA perspective what this is all about.
Okay, Mike, what this is that when the DCAA comes out to do a system adequacy check, they come out and check your system, they're coming out to look at your complete system. That would be your accounting package, that would be your policies and procedures, and so forth. They will do an oral discussion about your system. They have another little audit checklist, which they will make sure that they've covered their areas. And you will see that in the end they come down to the SF 1408, which is the summary of their findings. And in here you will see that the first item is that dealing with generally accepted accounting principles. That can be a make or break, but generally if you're doing an accrual system and you can get information into and out of your system, you're generally going to be okay on number one. Under the accounting system part 2 there, here's where they're actually more interested in those things that are for the government. That's the segregation of direct and indirect costs. That's the identification and removal of unallowable costs. And this just goes through, can you allocate out in your indirect costs to your direct costs? Can you provide reports? And those sections are the ones that really create the system that is good for the government.
Tom, there's an item on there about timekeeping systems and labor distribution, and I guess I've heard, and maybe you can elaborate a little bit, that probably some of the more frequent findings in a DCAA audit are related to either the timekeeping or the labor distribution.
That's very true. The timekeeping and labor distribution system are tied together, and what you create here is a situation where most of a contractor's costs tend to be labor. There are a few where it's just the other way around, where materials are the big item, but for most people it is labor. Most people are providing services, providing people. The timekeeping system has to be able to collect those hours that the people have worked and be able to explain what they have done. There's a certification process to that. And then the labor distribution system takes and puts those hours, it converts them to costs and puts that to the specific job or area that that person was working on. DCAA will hit this area extremely hard.
Okay, good. Thank you. Whoops. Got to gain control of my system here. With a QuickBooks system, I like to think of it as kind of a satellite system. When you use QuickBooks at the core, since QuickBooks is not designed specifically for DCAA requirements, in order to make a compliant system, you usually need some what I call satellites to interface with QuickBooks to provide different pieces to meet parts of the SF 1408 or meet the government requirements. So things like indirect rate calculations or job cost reports. And you've probably seen a lot of different ways of doing this, Tom, I would guess. Could you want to talk about kind of the whole system concept here?
Right. The whole system, this is where I had mentioned that it goes past just your accounting package. In this case here, we see on the far left there, we see policies and procedures. The auditors will be looking very closely at that because in addition to following all of the government rules, they also want to see that you have rules and procedures and those are followed. That's one of the things that kind of blindsides people because they think, well, hey, we just need to get it into the system and why do we need all this paperwork? But to DCAA, they want to make sure that you're following a system consistently and that you have a way for it to be followed consistently if anybody else comes in. But you're looking at a lot of the reporting, the incurred costs, the indirect. This is all reporting type information. Timekeeping system payrolls, there's inputs there. The more integrated these systems are with the general ledger, the better your system will be. The more times that you have to manually input something, naturally you increase those chances for error. You get up here, the subsidiary job costs. It was the job reporting that everybody knows about. The government, the auditors, your contracting officer, everybody wants to know how you are doing on this job, how did you accumulate the dollars, what should you be reimbursed for, and can you use this for future proposals if you have follow-on whatever you might have.
Okay. So you mentioned it briefly, but since these systems are external to QuickBooks, or a lot of these satellite systems, you do have to reconcile the data between those outside systems and what's in your QuickBooks, and that's where you get the chance for error, I would assume then, right, Tom?
Oh, yes, very definitely. Anytime that you have a system which is manual, you have a system which requires manual input, when you go from one system to another, you're never 100% certain that that is totally accurate, and so you wind up spending time having to go back, make sure that everything came across. The more integrated each of these systems are, the more reliable that data transfer becomes, and therefore less of a problem. Now you're more worried about the issue as to if somebody charged the right account, the wrong account, as opposed to adding on the error of did we put it into the wrong spot, did we not bring everything over?
Okay. So related to that, I thought it might be worthwhile, some people out there may be using other than QuickBooks today. When we talk about the general ledger in here, that's generally QuickBooks, but it could be another software. It could be Peachtree, or now that's called Sage 50 or something else. So I thought we'd do a quick poll just to see what people are using out there. So I'm going to have the audience just kind of take a quick poll here and give us some feedback on what they use. So if you wouldn't mind just taking a quick look at that poll and giving us feedback on what everybody's using today, would love to see what we're talking about here. So looks like we've got just about everybody has turned that in. I'll give another couple seconds. Okay, I'm going to go ahead and close that out now. Whoops. You have to forgive me there for not knowing exactly Looks like everybody here is reporting that they're using a QuickBooks system. So that's not surprising to me that we have seen other systems used as a general ledger, but generally speaking, businesses tend to start with QuickBooks. So not a big surprise there. So thank you for taking time to share that with me. I need to get back to showing our screen here. Okay. So in looking at the SF 1408 requirements, one of the first things that we saw on that list was the segregation of costs. And this is just an example here, but maybe, Tom, you can explain briefly what we're looking at, what the DCAA looks for when they segregate costs out in an accounting system.
Okay, Mike, what DCAA is doing when they come in, they want to see that you can differentiate between direct and indirect costs. That you can very readily see up above. You see the cost of goods sold, the 5,000 series of accounts. So these are being allocated or distributed out based upon your 5,000 series of account, bring in the direct. Your indirects are coming in the 6,000s and going on into the 7,000s and so forth. You see the first set there are your indirects of fringe benefits, your facilities. You see that there's allocations in there. So the DCAAs can look at it and say, okay, I can see that on your financial system you can separate between direct and indirect. And now the next one, which we will see in a little bit, will be unallowable costs. Can you pull those out to keep those away from those costs that are recoverable? And in this situation, like I say, we'll see that in just a few pages. And we come up, the next thing that the auditor will want to do is say, okay, I see your cost of goods sold, your direct labor, there's your timekeeping system coming in, the other direct costs of contracts and the direct labor, any indirect labors, any types of indirect charges. They will then want to go and take a look at your job cost system, and we will get to that one here in just a little bit also. But here you have your direct, indirect, and if we were to look down a little further on this page, and we will see in a couple pages, the segregation of your unallawables.
Now, Tom, on this one particular example, we see a lot of expenses collected together, like there's a fringe benefit, and then underneath that, there's a lot of subcharges. Is that what the government refers to as pooling, and why do they like the pooling concept?
Right. The pooling is a concept of bringing alike or similar charges together, and in this case you'll see that the pool in this case is fringe benefits. The like or similar costs would be your payroll taxes, FICA, Medicare, the FUTA. Then you, of course, also related to the labor, which is all fringe benefits, is your holiday, your vacation, sick leave, if you have personal time off, insurances. Those are things that are related to the employment of an individual and are considered to be a fringe benefit to them. So instead of having to take each one of these costs and allocate it, or as each person submits their timesheet, trying to break up each person's benefits to each job, they allow you to put them into an indirect pool. That's what these would be, the pooling concept, and then allocate the pool as its entirety. These costs will go into both your direct costs as well as if you have related unallowable costs that should have received some of them, they would also receive some of these costs.
Okay. The next thing that 1408 is interested in is how you allocate costs to a specific job. So this would be like direct costs. And we saw a few screens ago where within QuickBooks there might be some accounts for direct, but we have to further identify those costs as to what job they go to. Is that, and that's kind of what we're doing here, I think, Tom, is that right?
Correct. When you were looking back at your satellite system, one of the ones on the bottom there had the subsidiary ledger job cost reporting. And that's what this becomes. This is the subsidiary. This is taking each individual job will have their own number and will get charged the direct costs, and those will flow up. And then on your financial statements, you do not need that much detail. So the subsidiary ledgers get summed together and just reported as a total number rather than providing so much detail here.
Right. But this particular report we're looking at here is one out of QuickBooks, and you'll notice that it summarizes the direct costs very well because we can identify those within QuickBooks. What it doesn't do is it doesn't allocate any of the indirect expenses to that particular job or that particular customer. So again, that's part of the satellite system, something that has to be done outside of QuickBooks, as well as the calculation of what the actual indirect billing rates are. Normally you're going to have a provisional rate that you bill to, but you I'll let you talk about that, Tom. You need to monitor that billing rate through the year and why you need to do that.
Right. Your indirect rates are something that when you put your proposal together, you had recovery of your management costs, your buildings, your equipment, those things that you could not directly identify to a job, but are still necessary to the overall running of the company. And again, as we had just talked about, the pooling concept, here we see the pools: fringe, facilities, indirect, support type costs, and then those come together. In our case, we're doing it as a single overhead rate. We have it blended together, but we can break out all the component pieces. You will see many people, such as that center column, they will do their monthly. That is useful for you if you have a budgetary process and you're tracking on a monthly basis. You can see which months are going up, which months are coming down, where you thought you might have some changes from a straight line. Your year-to-date, though, is the one that is going to become the most critical, because when you go to submit your final invoice, when you go to submit your final indirect cost for the year, they don't care about your month over month. They're interested in what your year amount is. This is the most important piece, and monitoring these becomes critical in that if you see rates that are going way high or way low, you can line up with direct labor, you can line up with any of your facilities costs, any of your fringe costs, and it can be used as a tool, a budgetary tool, to say, where am I off, why am I high, why am I low? You can determine those variances, and then you can take a look at the costs that have come in versus what you know is going to be coming up. Maybe something got delayed, there will be costs coming in the future which will lift this up, or maybe some costs came in earlier. This will give you that management tool, and DCAA will be asking about this. They will be looking for this to say, how can we be certain that you're going to be able to look at your indirect costs and control them without having said that you're going to have a 30% rate, and the next thing we know, you're coming out and asking for 150%. So this reporting tool is a very good process.
Oh, good point. And you'll notice on here too that we have a certain amount of what I would call indirect or intermediary indirect rates, like a facilities rate here that's used to calculate the total overhead rate. And I think that's the power of the pooling to me, is that you can see if your overhead rate is getting out of control, you can see where it's getting out of control. Is it the facilities that are driving it? Is it the support overhead, indirect support? What is it that's driving that rate out of control? So like Tom indicated, that's an excellent management tool. I think with a QuickBooks system, I might point out that this is relatively easy to do when you only have a few contracts. As you get more and more contracts, it becomes harder and harder to do with QuickBooks. Would you say that's a fair assessment, Tom, in your experience?
Yes, it definitely becomes much more complicated as you get more contracts, as you get a wider variety of contracts. Probably the simplest contract to track is a fixed price contract. Once you start stepping out into the world of time and material or cost plus, while they sound easy and you say, hey, I'm getting my dollars back, your requirements for tracking those costs, for monitoring those costs, goes up significantly. Take one contract, easy to do, you can probably do it on a sheet of paper. When you get to 10 contracts, it becomes significantly more difficult. Likewise, when you have different types of contract types, you are in a situation where you have to keep in mind the rules for each one of those. You have to take and handle that. In the end, it all comes down to being one of complications arise and chances for errors increase as the system gets more complicated. I'm not saying that necessarily that one contract is easy to do, because you could have a beast of a contract which is requiring you to go down to contract line items or some other designations that people have, and having to keep track of all sorts of extraneous data which does not show up easily in a QuickBooks system or even in some other systems. But just keep in mind that contracts, as they increase in size, increase in people, increase in variety of types, the complications get significantly more and it's much more difficult.
Oh, good point. Thank you. So back to our, we mentioned earlier that timekeeping and labor distribution were some of the biggest items for findings in a DCAA type audit. Now, this particular example is built around a manual timesheet system. So use your imagination here, because this could be an automated timekeeping system. The DCAA and the government allow you to use either a manual or an automated time system, but both of those types of systems have to have the same type of controls. And what type of controls does the government look for in that, Tom?
On your time entry, in the days when you had a paper timesheet, it was very much something of how did you know what job you were supposed to charge? So therefore, how did you get that job number, that account number? You know, how did you know what hours to charge? They would ask those types of questions. Those are quite simple. But then you come to a situation of somebody says, oh, you know, I put in 4 hours there on that Tuesday, and it turns out that I actually had to go home sick for, you know, and so I only got in 3 hours. So you know, you can't just simply go in. The DCAA does not permit you to just simply go in and erase that 4 hours and put in 3. What they want you to do is all of these sheets they want in pen, so that way they can see corrections. They want to make sure that you don't have multiple timesheets. And so the only way that you can correct it is by putting a single line through and then putting an explanation down and initialing the time change, indicating that the employee is aware of the changes and they concur with it and why it happened. Now when you get to the bottom of the paper timesheet, you'll see the person has certified that this is their timesheet, it's true and correct. There are penalties for certifying a timesheet which is incorrect. And then naturally you have a supervisory approval which comes through and says, I concur with what the employee is stating here. From my oversight, this is what I'm there. Again, that is still a certification by the supervisor, and there are responsibilities. If it gets significant, the government can come back in and file charges against people who have filed false timesheets. When you switch over to an electronic timesheet, you get a little bit different. You no longer have that sheet of paper. You don't use the pen. But what they still want to see is they want to see, how did I get these numbers? That tends to be fairly easy in an electronic timesheet because you select it off of a list and you've been told and given authorization for certain jobs. You input your hours. If you go and make a change, they want to see that that accounting that timekeeping system will keep track and make a record saying, hey, this used to be 4 hours, now it's 3. And they also would like to have the system say, why did you change time sheets? Do you agree with this? Who made this time sheet? It should be recording all that information. And now instead of handwritten signatures, they tend to go to an electronic signature where the person is given a passcode, and then the system recognizes that because only that person knows what it is, and so therefore their signature is noted as having been electronically signed. So the two sheets, the two systems are very similar, have very similar controls, and in the end, now DCAA really prefers the electronic because that means that they can get more reports out of systems generally.
Tom, I've heard a lot of people tell me that they're using an Excel program-based time system. Does the DCAA have any problems with an Excel-based time system?
Well, with an Excel-based time system, unless you can insert these other controls, as I had mentioned, the changing of time, you know, when the timesheet was completed, those types of things, since the timesheet is supposed to be completed on at least a daily basis. If it cannot track that, DCAA is going to have significant problems. You may find an auditor who accepts it, but I would be wary because the next auditor coming in will probably look at it and say, you know, I don't like this because you can easily and readily change this. Ways that I've seen gotten around this, which auditors tend to go for and accept, however, they still kind of frown on the whole process, is for at the end of each day, everyone who has an electronic timesheet or a timesheet like this that's done in Excel needs to be backed up, and that creates a real headache because now you're saving daily timesheets up and putting them into a PDF, so that way later the auditor can come back and say, wait a minute, there were changes made here, but there was nothing noted or no comments put on. So just be careful when you use an Excel system that if you cannot get to these controls, DCAA is probably not going to accept it.
Right. I just want to take a quick minute out for another poll here just to see what people use for timekeeping systems. So if we can take just a couple seconds here and fill out a quick poll, use a manual type system, to use an electronic type system. I know everybody in the previous poll was saying that they had used QuickBooks system, so we probably are going to have a mixture here of different people using different types of systems. Let's keep that open for just a few more seconds here. Don't want to take too much time with these polls, but want to kind of get a feeling for everybody. I keep getting the wrong screen there. Okay, it looks like about 50% are using a manual timekeeping system, which surprises me a little bit. There's some really good tools out there today for automated systems that integrate well with QuickBooks, and there's 20% using those, and then 30% are using some other type of timekeeping system. So very interesting results there. Okay, I'm going to close that out. There we go. So next, from the timekeeping system, we need to get that data into the general ledger system or into the QuickBooks system. And typically that goes into, if you're using a QuickBooks system, goes into this time entry sheet where we can begin a labor distribution process. So this is another place where the data is usually manually. You can see this particular timesheet is the manual duplication of the actual timesheet that we saw on the previous screen, just had to be entered into QuickBooks. There's two ways that that can happen. One is a manual entry where somebody enters it, which of course, like Tom mentioned before, raises the chance for error because now you've got a human element involved. There are some of the electronic or automated timekeeping systems that allow for electronic input into QuickBooks, which tends to help reduce those errors. But one way or the other, we need to get those hours into QuickBooks so that we can do a labor distribution. So if we get that into this particular timesheet module within QuickBooks, then we can use it. And Tom, maybe I'll let you explain a little bit about the labor rates and how those are used, especially for salaried people, in order to distribute the labor within a QuickBooks type system.
Right. One of the requirements in FAR is that your costs be allocated, and they must, of course, be actually incurred. When you come to a timekeeping system, and if people are paid on an hourly basis, if you're paid $10 an hour, whether you work 5 hours or 40 hours, you get the $10 an hour. If you work overtime, generally you get overtime premium. So the first, the single rate will be your $10 an hour, and then your overtime premium will be whatever it is. Generally, you see that's a time and a half. That's another 50%. When you get to a salaried individual, it becomes a little different, because a salaried individual tends to be paid an amount no matter how many hours they work, whether they work 10 hours or 80 hours or 40 hours. While their timesheet may have been based on 40 hours, and that's something that DCAA will ask for, is what is your standard hours per year. What will happen is if you come in and say somebody is paid $100, that's a little low. Let's go with $1,000 for 40 hours worth of work generally. If that person works 80 hours, instead of it being the $25 an hour, it's now down to 12.5. That would be the rate that DCAA would be looking for you to allocate. It would be 12.5. There's 2 or 3 methods to do it. The equivalent hourly rate is the preferred method. And so do you want to be sitting there and recalculating, let's see here, the person normally gets on average 25 hours hour, $25 an hour, or do you, and now they're going to be 12.5, or if they go the other way, now they've only worked 20 hours total, so now their pay rate is up to $50 an hour. It's just the type of thing where that allocation, the labor distribution piece, becomes very critical, will be looked at very closely by DCAA. This is where they look and identify on those people who are salaried, something called uncompensated overtime. They don't care if you pay the person $1 an hour or $20 an hour or $100 an hour. There needs to be some type of compensation, and in general they look to see that it's reasonable, and that's just a quick look. Again, like I say, they don't care if it's $1 or $100, but generally they're thinking, hey, whatever the person was paid during that time frame divided by the number of hours must have been a reasonable rate at the time. And so one week the person may be getting $50 an hour, the next week they're 25, and the week after they're 12.5. It's just something to keep in mind. Avoid that uncompensated overtime issue.
And sometimes that's hard to avoid because people, especially salaried people, may put in extra effort. So it definitely is an issue of concern. And I would say with a QuickBooks-based system, it becomes harder to manage the more employees, especially the more exempt employees that you have on the payroll.
Yes, it definitely becomes more complicated. I mean, it tends to be more complicated in any system, but in QuickBooks, yes, there is a way to do it, but what you do is you find that oftentimes it starts to apply that same method to employees that you did not want it to apply to. You will look at other packages, you know, Deltek and a number of others that have really developed their software for the purposes of the government, and you will see that there you just throw a switch on indicating that the person's salaried, and you click the other checkbox saying if the person works more or less than the standard number of hours, calculate an equivalent hourly rate. So it becomes a very simple process in that situation. People who are doing this manually or want to avoid some of the complications that you can run into on the QuickBooks equivalent hour calculation, because your reports will look very strange from that report. What you wind up doing is sitting off with a calculator, pen and pencil, some paper, and you're calculating, and if you have 20 people and then you have to do it for each week, you're starting to add up to quite a bit of manual calculation.
Right. Okay. The other thing that we talked about earlier, and finally get to it here, are the external subsidiary job cost reports. So this is a job cost report that Tom had talked about earlier that's very good to look at on a monthly basis, where it not only shows the direct expenses to a project, but it also shows the correct allocation to that particular project, or that, in this case, that's the particular customer, of the indirect expenses. And it shows not only where you are this month, but where you are year to date on this particular contract, and where you might be contract to date on that, especially if a contract spans over more than 1 year. So maybe you can just summarize real quick, Tom. I know we talked about it a little earlier, but the importance of this type of reporting.
Right. The government requires that you be able to accumulate your costs on at least a monthly basis. So they will be looking for a report like this. While a monthly basis doesn't necessarily say a whole lot, their viewpoint is, hey, if you can do it monthly, that means that you can do it annually. If you can do it annually, you can add together the annual amounts, and you have your project to date. Oftentimes, when there's sequestration or something going on, or if they want to make some modifications, maybe you even have requested some changes to the contract, they will want to get the most recent report possible. They may even ask that you take the prior month. In this case, February is closed, you've got it, and they'll say, now would you update it for the March costs? You know, you don't have to be exact, but please bring it fairly close so we can see where we're at. The contracting offices look for it. DCAA will look for it more or less just to make sure your system is compliant that way. So anytime that there is a question, that happens. But these reports also give the contractor the ability to look at the jobs and say, am I making money on this job? What has gone off base? Again, it's another tool excuse me, that you can look at. You can say, you know, our labor is much higher than we thought, or our use of consultants, or whatever the cost might be, and then you can look at that category and say, did we bring it in early? Is it still to come? Did we just miss it? The contractor can also use these reports to say, hey, we're at about 65% of the cost, because a lot of contracts are funded incrementally, and you have to let the government know. They aren't watching it for you. You have to come back to them and say, hey, we are going to be at the 75% mark or 80% mark, whatever it is they have established, and it's up to you to request additional funding. So you need to keep that money flowing, because if you request it late, A, you will be dinged, and B, it will probably slow down your cash flow.
Good point. Also, it's worth noting, I think, this is one project here, so one job. And I think it's relatively easy to manage one job. As you get more and more jobs, since this is done outside of QuickBooks, you're basically managing the data that came from QuickBooks in order to create this report. This particular one was done in Excel. And so you've got the chance, like Tom talked about earlier, for error when you're exporting the data into an Excel spreadsheet, and then maybe making different worksheets within that workbook to create different job reports. You've got a lot of data that you're trying to manage and reconcile to make sure it's the same data that's still in QuickBooks, to make sure it's not impaired in any way in creating this report. And this is, I think, Tom, you mentioned this earlier about the unallowable expenses. Why is that such a concern to the government?
The unallowable expenses are something that there is a history to that. Back when the FAR and the cost accounting standards were first being put together, it was shortly after the Civil War. At that point in time, they found people charging all sorts of things. They continue to charge all sorts of things. So the government has come up with a system. They have, and I actually, now that we speak about it, just within the last day or so, I was looking on a board that I'm on, and they were questioning about unallowable expenses and those things that are specifically or explicitly unallowable. Those items are stated right in FAR 31. Those are your specific unallawables. That is your advertising. That is, you know, a number of the contributions, entertainment. Those types of things are specifically unallowable unless they give you the freedom to have that. You can also have unallowable costs come up from your contract. The way it was written, the government may say, we will not pay for these costs, so that gets thrown out. You may also create unallowable expenses, possibly unintentionally, in that you may, when you propose a contract, you may automatically exclude certain costs, or maybe your policy and procedures say that we do not charge these costs. What will happen is the auditor will see those, and if at any point in time they see some of those costs come in, those will be unallowable costs. Those costs will not necessarily be subject to the penalty provisions because that will be something that is explicit. But if the costs continue to show up, you could be subject to those penalties, and those penalties can get to be fairly heavy. And so here we've got the distribution of the costs, and just like we had for facilities and the fringe and things like that, it's broken down. That way you can readily see what it is. Would you need to break it down this far? No, but the government is happier to see this type of thing, because if you can break out advertising versus contributions, things like that, it pretty readily tells the auditor that you are looking for these things, that you are pulling them out. So if they do run across a cost that was inadvertently charged to the wrong account, as long as it doesn't happen frequently, the auditor will say, okay, this was just an error, and you'll get dinged for just an error. If you do not have this type of setup and you do not have the policies and procedures, then the auditors are going to say, I don't think your system is really capable of this, because nobody has any guidance, nobody has any way of looking to see what is good, what is bad. Get your unallowables out of there, and you'll make your life a lot easier.
Now, these can vary from agency to agency too, is that right, Tom?
Yes, they can. You will see some agencies, once you get past the standard FAR, and you have others, like the Department of Energy has a version of the FAR, which is actually, and so does the Department of Defense. They add on additional regulations, so you can run into costs which they will not pay for. And on each, like I say, on each contract, maybe Department of Energy will pay for one thing, but Health and Human Services will not pay for it. So you have to keep in mind, if you have contracts in both agencies, you wind up having to attach them or work with them in a manner that will accommodate both. In some cases, if it's a direct contract unallowable, what you'll wind up doing is you'll be pulling it in marketing it as unallowable on the one contract for your one agency. The other one will still be allowable. You're fine. If it's an indirect unallowable, if it's one that's at a higher level, not at the direct contract level, now you get into a bad situation, because if that winds up in your pool, you technically are charging that to the contract. The contract office or the agency that has that contract can come back and say, whoa, wait a minute, you are charging us unallowable costs. Your argument is that's just my indirect costs. And they will come back and say, no, we told you we would not pay for any of those types of costs. What they mean is they will not pay for it directly or indirectly. It's unallowable, so what you wind up doing is having to pull it out from all of your contracts. You will lose it from all your contracts.
Just to summarize, I want to go back to Form 1408, and I did kind of a color system here, red, green, yellow, where the green is something that you can probably use the QuickBooks system out of the box, where the yellow, you can use the QuickBooks system, but you're going to have to make some special modifications in order to meet these requirements within your QuickBooks system. In other words, you'll have to set it up a specific way. And then the red items here are things that have to really be done external to the QuickBooks system. So this is kind of in my mind, a good way to summarize setting up a QuickBooks or a similar type system for government compliance of where the danger areas are. And I said red, the external systems are the danger areas because that's where you get into exporting data out of QuickBooks. You have to reconcile, make sure you got that same data in both locations now so that everything ties together. Just kind of a good little summary of what we've been talking about here. The final thing that we had, especially in our little satellite picture, was the incurred cost proposal. And for those of us that do cost type contracts, the government requires us to submit an incurred cost proposal every year. And those end up being audited quite a bit. I think last year the DCAA did something like 6,000 incurred cost audits, Tom. I'm not sure of the exact number, but maybe you can elaborate a little bit on the difficulty of doing an incurred cost submission and the audit pitfalls there.
Right. An incurred cost submission, many of you will recognize it as they go now. It used to be called an incurred cost proposal. Now they call it an incurred cost electronic, the ICE. It's really the same submission. And like the original, which is the version I actually prefer, it's actually a proposal. This is like when you went for a contract. You were trying to get the government to pay you for your indirect costs, but you must also prove that where those costs go. And in this case here, on this particular page, you're breaking down the direct costs of the contract, your labor, again, important, that came out of your labor distribution system. So the more reports that you have and the more accurate those reports are on your other pieces, the easier this is to complete. Preferably this is more of an electronic completion, and then you just have to modify it. But you will see as it goes across, it has all of your direct costs. Then it starts adding on overheads, G&As, cost of money if you might happen to have that. For most people, that is nothing but a headache. And then eventually what your total costs are. The incurred cost submission winds up running, it's not unusual to see an incurred cost submission running 50 to 60 pages in length. They are going to require that you reconcile your general ledger, that you reconcile your labor costs. This one here will start to pull in your other costs for travel material. That will help reconcile some of it. If you have time and material type contracts, since the material portions can still receive G&A back, you have to be able to reconcile that, and you have to actually detail that by contract and by labor category or whatever you used for your labor, and then add on the costs. These sheets can be quite complicated. There's also errors generally within the government's package when they send it out, and you will see one auditor that if you're off by 1/10 of a penny, the system is unacceptable, and others say, hey, if you're within a couple of dollars, we're fine. So it really is going to depend upon your auditor. They really haven't specified how accurate each office needs to be. But as you can see along the bottom, you can see the schedule A, B, C, D. I mean, these things go all the way on out, and you have to put in executive compensation. You have to put in a list of your contracts and modifications that you had. If you do not do it in this package, they will come back and ask for that. The more your system can provide this information to you, the better you're going to be, and the easier that this package is going to be.
Well, especially when you have a lot of different contracts or a lot of different employees, because it just becomes more and more complex with all those variables.
Yep, I've actually found that on that sheet on incurred cost submissions, I still have a number of people who are in the DCAA, and they've kind of sped up trying to catch up because they were way behind, even though they've hired a lot of people. But they still say that the biggest problems that they have are people completing these sheets because people do not really understand them, and they make it very complicated. And you think something should go from one sheet to another sheet. Maybe it does, maybe it doesn't. But in the end, this is where they seem to find the most errors. They say standard proposals, rarely do they have much complication with it. They may disagree with something, but here they actually have factual information they can look at, and they find a lot of errors on these submissions.
That's a good point. And just checking for math errors is probably a good thing to do in here, although with the complexity and the number of worksheets that you have in there, sometimes it's hard to catch all the math errors even.
Right. You really need to learn what the relationships are of each of the schedules and which ones flow which direction, and make sure that they're tying out with your system. Again, another method of reconciling your system.
Yep. And along those lines, I mean, with the incurred cost submission, but what we're talking about with budgeting, with predicting your indirect rates, all those things that you want your system to be able to help you do, the complexity grows as you get more employees. I mean, here's an example of a 11-person company that has 9 jobs, and immediately you can start seeing, this is just the labor budget, and it's summarized per year. A lot of times people want to break that down into monthly, and obviously this is a spreadsheet. It's done outside of QuickBooks because QuickBooks doesn't have this capability. So again, as that complexity grows, there are reconciliations that data has to tie back and forth to one another, tied to the incurred cost submission, all of those things. The data has to be the same. The more satellites, the more balls you have in the air, the more chance for error. In this particular depiction, I'm always a fan that a picture tells more than 1,000 words, but I'm not sure that this picture is the best. If you're an engineer, maybe it makes sense to you. Otherwise, maybe it's not the best. But what I was trying to depict here is, as the number of variables grow, and variables, there's 3 or 4 different variables in your system. There's number of employees, there's number of contracts, there's number of bank accounts, number of locations, maybe number of departments that you have within your company. As those factors grow, the complexity of the system tends to grow exponentially. And so that's a factor if you're using QuickBooks and you're growing to consider, is how many of those variables are really driving the system, how many are growing. We had one final poll here that I thought was interesting that I'm going to set off right now. Just wanted to see what people thought about your system. Do you think your system is becoming very complex? Are you satisfied with the amount of time it takes for you to do things now within your QuickBooks system? Where are you in the progression of your growth relative? I know everybody's using QuickBooks, but let's take just a couple seconds here and vote on this particular poll. I think I've got it up. Yep, I do. So let's take a real quick look at that. I just want to take a couple seconds here.
Yeah, Mike, one of the interesting things.
Okay, I'm going to close that down in just a couple more seconds here. Okay, I'm going to close it down. Looks like we had the majority, there's 36% said they're fairly detailed, but they're efficient in what they're doing, which is good. That means it's manageable. Another 25% said they're satisfied with the amount of time it takes. And then we got a few people up in the very detailed and very complex area. There's not very many in that area, but there's a few people that are getting up on this exponential curve. So about what I would expect to see as systems grow. So what are some of the symptoms? I always like to look at things the way maybe a doctor would. If you came to a doctor and said, "Doctor, I'm not feeling well today," well, he's going to ask you, well, what are the symptoms? Why aren't you feeling well? So in your QuickBooks system, what are the symptoms that you ought to look for that maybe your system is starting to be something that you're outgrowing? One of the things that I think it makes the most sense to look at is, does it take more time to close your books each month? If it's starting to take more and more time, if the monthly closes are delayed, that could be a symptom. That could be a sign that your system is becoming very complex, hard to handle. Obviously, there's other, just like with a medical symptom, there's other things that could point to, but that's one symptom that might be an indicator. Others are if you notice that you're finding more and more math errors, like Tom was talking about before, trying to reconcile the different satellite pieces together, and you're finding, oh gosh, this one doesn't tie, or there's too many math errors between this worksheet and this QuickBooks account that's not the same. That might be an indicator. Too many reconciliations. Are you constantly reconciling data between one system to another one, and you're sitting there going, gosh, all I do all day is reconcile between this system and that system? You have doubts about compliance. Are you doubting whether you can pass a DCAA type audit? Usually that's an indicator that there's something wrong with the system, or not wrong with the system, but maybe you're outgrowing the system. Do you not have management reports that you would like to see for effectively controlling and growing your business? Maybe QuickBooks isn't capable of delivering the type of reports you need. Maybe those reports are being generated outside in Excel. Maybe it takes a lot of time to generate those reports. All those type of things might mean that the system is becoming difficult to operate. And are you having a difficult time preparing your annual incurred cost submission? Is it take too much time, too complex? Maybe there's too many variables going into that, those type of things. So all of those are kind of symptoms that point to maybe the system is starting to be something that you want to take a look at, that you might be outgrowing. So I guess the next thing is, where do we go from here? I appreciate everybody participating today. I appreciate, Tom, your participation. Thank you very much for joining us here. If there's any questions, we'll be happy to stick around and answer those. We do have a follow-up webinar tomorrow with one of our partners from a software company that does make a out-of-the-box compliant DCAA software, and it's Microsoft-based. So it's a very good system, especially for people that have used Microsoft products. You'll recognize a lot of the familiarity of that type of system, and it's designed to meet all the DCAA requirements, including up to Schedule H in your ICE submission. So we're going to have a webinar tomorrow. If you want, we'll be sending out an email here shortly with instructions on how you might sign up for that if you're interested in seeing what that software looks like. If you have other concerns, and we might be able to help you answer some of those concerns, feel free to contact us. You can send an email directly to me or give me a call. Be happy to help anybody that has questions or concerns in any of those areas. Other than that, I think we'll just open it up for questions. If anybody has a question. And Tyler, I don't know if you you were kind of watching the questions as we went along. Maybe you can chime in here and give Tom and I any questions that might have popped up here.
Let's see, we have We got a few of them here. Let me go through my list, though. Give me a moment here, Mike.
Okay. Again, I want to thank everybody for attending, and I know government compliance can be a difficult thing to do, so it's never a slam dunk, never easy. Looks like the only question that I see here is what would be considered unallowable labor fringe. I think that's the only, maybe it's an incomplete question. What would be considered unallowable labor?
Okay, I'll take that one. Unallowable labor is going to be, it can come in through a variety of things. Unallowable labor could be you went to a party. Well, since parties are unallowable, if your company allowed you to charge time to the party, you know, whether it's a Christmas party or whatever it is, that's considered entertainment, unallowable, and so that would not be allowed to go into like say a fringe or an overhead type of account. If you are on a contract, a lot of contracts allow you to do the work as specified in the contract. However, many times if they come back and they say, hey, this was not done correctly, you need to redo this, many times they will declare that labor is non-chargeable. So in effect, it's unallowable. It stays on the contract. It is not chargeable, and yet you still have to take your fringe and your overhead that's applicable to that, still charge it to the contract, but since it is unallowable labor or unbillable labor, at that point in time you have some additional costs that are unbillable.
Very good. Okay, well with that I think we're going to end the webinar. I think we're real close to the ending time. I want to thank everybody for your participation today, and hopefully we'll be talking to you again soon. Thank you very much.